your internal rate of return or your actual return, which was the word he used, is like 16% on your money. That's way better than 7.53.
That's over double.
Over double. So he was thinking, and the cap rate is my return, and if I buy this, I'm going to make 7.53% on my money. That is not what a cap rate tells you.
Cap rates.
The most misused term in commercial real estate.
No cap.
No cap.
This is Bo Barron CCIM.
Oh, we're still doing this. I'm sorry. I went somewhere else.
No, you're good. We'll do this one.
Do it.
This is Bo Barron CCIM.
And this is Timmy Barron, ADHD.
And I know nothing about commercial real estate.
And I know nothing about acting.
This is your new favorite commercial real estate podcast, commercially speaking. Perfect. Teach me about cap rates.
Have you ever heard the term cap rate?
I've not heard that term.
I don't know why you would. I was just curious.
I do got to say, though, like cap is being used as another word for crap.
Oh.
Like no cap. And if someone is spouting off bullshit, it's like, that guy's cap.
I learn all kinds of things when I'm trying to teach you something.
That's right.
So let me start at a higher level here. Cap rate stands for capitalization rate. That's a lot of syllables for an industry full of lazy talkers. So we're just going to say cap rate. But this is the most, you're going to laugh every time I say cap rate, aren't you?
For the very close foreseeable future.
Well, in my opinion, cap rate is the most misused term and misunderstood term in commercial real estate. People misuse this thing all the time. So let me share with you what it is. I don't know what the book definition of capitalization rate is, but here's essentially what it is. You buy a property for $1 million. Let's say it produces $100,000 in net operating income every year. The cap rate would be 10%. You take the net operating income of a property, divide it by the value, and it tells you what the cap rate is.
The value that you paid for it?
If you're figuring out the cap rate when you buy it, then it is what you're paying for it. If you're figuring out the cap rate for 5 years in the future, then it would be what the value is, because there might not have been a sale.
Sure.
But it's the current value of the property. I'm sure there's exceptions to this, but it's basically just talking about that year. So think of it this way. How much would you pay to capture that $100,000 in rent?
How much would I pay for that building to capture $100,000 in? You're not saying rent?
Rent's really not the right metric, because net operating income, that's the metric you use to figure out cap rate. What net operating income is it's all the income that the property generates.
Rent being one of those.
Rents it's the revenue and all the property specific expenses that building has. Property taxes, insurance, utilities, maintenance, contract labor. What you don't include are the owner specific expenses, like, is there debt on the building? If there is, the owner is paying a mortgage payment. That's an expense that has nothing to do with the building and everything to do with the fact that the owner went and got debt. That's essentially what net operating income is. The cap rate is just, what's that percentage? It kind of gives you a feel for what's the risk of the property. And here's how you know that. If I bought an apartment complex in Owensboro, Kentucky, population 100,000, where I live. Now, why do you think it would be worth more if it were in Chicago?
Well, the population?
Population is really the right answer. There's just way more people in Chicago than there are in Owensboro. So there's going to be way more demand for apartments. It should perform better. The rents should be higher. You've got a large, much more diverse economy. Chicago loses a couple major employers. People will be affected, and that'll ripple out, but that property should be just fine. So cap rate, in some ways, gives you a feel for the level of risk. That's all it tells you, but people misuse it all the time. I'll tell you a story, and you know this guy I'm talking about, but I'm not going to name him.
Okay.
We had a really small investment deal, but about a month ago, I'm talking to this doctor because he owns a property around the corner. And so I called him up. I was like, you already own in this area. You want to take a look at this little office building? I think it's 2,700 square feet. We were asking $325,000 for it. The cap rate is 7.53%. So just based on what you know so far, it costs $325,000 and it's a 7.53 cap rate. What's the net operating income of that building?
Well, you would multiply 325,000 by 7.5%.
And it would give you
the number that we're looking for.
Somewhere around $24,000 a year. I take this doctor through. He's going to think about it. He calls me the next week, and I'm actually teaching a CCIM course in Louisville that week. And I was explaining cap rate and NOI to the class. Right after that, during a break, he calls me and he confirmed he was talking about the cap rate. He was looking for something more like a 9% cap rate, which means for the dollars, he would have a higher net operating income. What he should have been looking for is the internal rate of return, because the cap rate just tells you in that particular year, at that point in time, what's the relationship between the value and the net operating income. But if you buy a piece of property and you think the cap rate is the return, then you're assuming that the rents will never go up and that you're going to sell it for what you bought it for. But in fact, rents do generally go up and properties do, not always, but they do appreciate. And if you want to capture that growth in cash flow and that growth in your exit sale value, then you need to look at your internal rate of return. This particular lease in place in this little office building had 2% rent bumps. Every year the rent goes up by 2%. Well, if you just look at the cap rate, you're not factoring in that growth in cash flow. But if you forecast 5 years of rent growth and selling at an appropriate amount of appreciation at the end of that, your internal rate of return, or your actual return, which was the word he used, is like 16% on your money. That's way better than 7.53.
That's over double.
Over double. So he was thinking, and the cap rate is my return, and if I buy this, I'm going to make 7.53% on my money. That is not what a cap rate tells you. And if you factor in debt, the internal rate of return gets even higher. Now, you also increase your risk if you do that. That's how people, man, they misuse cap rates all the time.
You said that other real estate people misuse cap rates as well.
It's too simple of an idea, and so it gets co-opted to take the place of more complicated measurements. But all it tells you is the relationship between the net operating income and the value of the property in that year that you're measuring it. Now, there's a couple other metrics that you generally need to understand when you're talking about cap rates. One of them is internal rate of return. Mm-hmm. Internal rate of return says I'm going to put this much money in when I buy it, and then I'm going to project a sale at this amount of money in the future. And then you can calculate what your internal rate of return is. What that number tells you is, while my dollars are in that deal, this is the average annual percentage of return those dollars are making me. So when we put our last group investment deal together, we bought a strip center for $3.5 million. I showed them if we can increase the rents from about $12, which were the average rents, to the market rent, which is $18, if we can just get to $17 over the course of about 3 years, we should be able to sell for about $5 million. And if we can accomplish that, your projected internal rate of return will be around 16 to 18%. So these 12 people who invested in the deal did so because I told them I thought I could get them an average of 16% return on their money annually.
Oh, that's annual.
It's an average annual. Most of that's going to come when we sell at the end. We put $3.5 million in it. We get $5 million out. Most of that comes at the end. And when you average it over, say, 5 years, 16, 17% is what you get.
16, 17% is what you get per year, and you combine that together.
Let me describe it to you this way.
Okay.
I'm going to do it by introducing a new metric.
Great.
Cash on cash return. What it says is I put X amount of dollars in, and this year I get X amount of dollars back out. Their average cash on cash return is going to be around 7%. Not a huge number. That's as we're getting those rents from 12 to 17 or higher over the course of about 3 years is what I told them it would take me. They're going to get a big check. And when you take all those 6 to 7% cash on cash returns and you add it to that lump sum they're going to get when we sell, and you average that amount of money over 5 years, the average is 16 to 17%. Does that make sense?
Yeah, that's the IRR.
And a lot of my investors start at that same place. Like I've had that conversation with a lot of people who have decided to come into the deal or decided not to. Some people are interested in a deal. They want more cash on cash return. They didn't care for this deal a lot. Some people looked at it and they liked that 16, 17% number and they're willing to wait for it, which this particular deal requires them to be able to wait for it for 3, 4, 5 years. And so that's better than they think they could do if they bought a CD or bought bonds or any of that.
I'm getting a more appreciation for what you do as well, because not only do you have to know this stuff, how to calculate it and think about it in this way. Oh, sorry. Okay, great. Not only do you have to understand, but then you in turn have to explain it in a way that makes sense to an investor? Because I'd imagine most investors aren't necessarily, like, they're using you because you know this.
I'm in small town Kentucky. And so when we put a group investment together, I'm generally talking to people from the area that I have relationships with that at least at a baseline level think I know what I'm doing, because they're going to trust, if they jump in the deal, they're going to trust me with their dollars. If I were in, say, Chicago, I might be doing bigger deals with, I hate to say it this way, but maybe more sophisticated investors that have like cash on cash, internal rate of return, things like MOIC or EM. And there's a lot of other types of metrics that they might have a real handle on. In this deal, we had a commercial insurance guy, contractor supply, business owner, had a guy who owns a plumbing company, had one of my fraternity brothers from college. It was not
Professional investors?
Yeah, they're not professional. A lot of these guys are blue collar business owners. And this area of commercial real estate investing, this type of deal was a new concept for them. And so I did get to explain it a lot. That's more of an environment of who my circle of influence is and where I live.
Yeah, that makes sense. You created a syndication deal with several people in the community that you know that have the money to be a part of it, really just looking to put their money in a place that's going to make them a bit of a return, and they trust you with that.
Yeah, that's right. You think, let's say you have a very successful business and you're flush with cash and you know nothing about commercial real estate, but you would like to invest in it because it does offer good returns, but you don't have the knowledge base or the expertise or the skill set or the time to go buy something and operate it and lease it up and deal with the tenants and manage the leases. That's a whole nother job. They don't want the job. They just want to be able to invest in it.
This might be a question for when we talk about making your first deal or first investment. Not deal. I mean, I guess you're the one doing a deal. An investor would be, I guess they'd be doing the deal as well.
Yeah, it could be either way.
Right. There it goes. Bye.
Goodbye.
Are you having fun yet? If you are in fact enjoying these videos, I want to invite you to subscribe to our channel, turn on that notification bell, ding ding, and ask us any questions you got in the comments. Back to the good shit. Yeah, you see, I had this question, and then I really wanted to impress you with using the term syndication.
You used it well.
Thank you. Oh, it'll come back. I forget.
Let's go back to cap rates a little bit.
Great.
Now, we'll mention this.
I remember.
All right, let's do it then.
Yeah, a syndication deal, you're getting the money from other people. Why would you do that over going to a bank?
That's an insightful question, and it'll probably take a fairly extensive answer. We might want to save that. Now, let's see if I can work back to what I was thinking about with cap rates. Okay, let's take this deal I've been talking about. We bought it for $3.5 million. We're trying to make it worth $5 million over the course of up to 5 years, and then we'll sell. Or that's the plan. We bought it, I think, at a 7.5 cap. $3.5 million times 7.5% tells you what the net operating income of that building is. Now think about the cap rate in this way. 5 years in the future, I have some amount of control over increasing the net operating income. If I do my job well and cap rates go up, the value won't be what we need it to be. When cap rates go down, values go up. You know what helps cap rates go up? An increasing interest rate. And we've just gone through, some of the most aggressive increases in interest rates in my lifetime. That's the risk when you look into the future and you say, okay, I can get rents from here to here. I can manage this well. I can improve the net operating income. What I can't control is macroeconomically what's going on. And I have zero control over what the Fed does. I have zero control over Putin going into Ukraine. I have zero control over gas prices and inflation and all this stuff. We live in that context. We're going to have to roll with it. So the cap rate could be 9% by the time we're ready to sell. And if that's the case, we might decide to hold it longer. Or the next presidential election could change everything, one way or the other. And things could get a lot better as far as cap rates are concerned. And we might hit the gold mine when we're ready to sell. If cap rates compress and get smaller, there's really no way to know. But we just had essentially a 12 to 14 year run where the economy continued to grow and cap rates continue to get smaller across the country. They continue to compress and get lower and lower, which drove values up. That's got to stop at some point.
So
and then it'll come back at some point too.
Yeah, that's where I was going to go. Is there a chance that that cap rate never swings back down?
I mean, there's a very defined business cycle in commercial real estate, and I don't see that cratering and going away. I fully expect them to come back down again.
Yeah, and based on history too, the ebb and flow of.
Yeah, that's right. The real estate cycle that's a whole nother episode. Say you and I owned an office building in Chicago, and we could determine that we're at the top of a market. So rents have been going up for a while, occupancies are high, and we just look around and we see, and there's a lot of other developers building new product in the market. It's gonna add a bunch of supply of space.
Mm-hmm.
That'll probably cause the market to increase its vacancies, which will depress rents a little bit. If we can determine we're at the top of that market and we're in a lease negotiation with a tenant, what do you think we'd want to do? Do you think we'd want to lock in a long-term lease or lock in a short-term lease?
Short-term.
You're the owner of the building. If you think rents are at its peak,
lock it in.
You want to lock in a long-term lease, right? If we see we're at more of the bottom of the market, as a landlord, I'd be more inclined to do shorter-term rents or shorter-term leases so that we can capture some of the growth and the upside on renewals. So yeah, understanding the real estate cycle and where we are in the different asset classes, like it's different for office than it is for apartments as it is for retail and industrial, and it's different in different markets. It's really interesting. And there's a guy at the University of Denver named Dr. Miller who is the absolute expert at understanding all of that. Really, really interesting stuff. It'd be a home run if we could get him on the show.
Yeah, that'd be cool to have him on. I'd really love to pick his brain.
Every time I hear that phrase, pick brain, I think, man, that feels like it would hurt.
Yeah, it would. Yeah.
Here's my parting advice to any aspiring anybody who wants to meet, have a conversation, learn from someone who is successful and busy in their field. Never use the phrase, pick your brain. A, it sounds painful. B, it sounds like it's only going to benefit the one person. Hey, can I have an hour of your incredibly valuable time solely for my benefit? Would that be okay with you? There's better ways to do that.
And I just had a meeting. That guy was picking brain, man. He came right in, just picked brain.
Boogers everywhere.
I'm going to go take a shower. I'll be back. Well, thanks for letting me pick brain.
Yeah, anytime, man. Anytime. Sounds like fun. Oh, boy. All right, so Quickie Quiz. Or you, I should say, came up with this idea of doing the pop quiz at the end of the episode after we'd done a couple episodes. So, man, let's go back and tag on some Quickie Quizzes.
Let's do it.
Question 1. What's a cap rate? Like, what does it actually tell you?
The cap rate tells you the value of the property that year that you're going to buy it. Is that?
No.
Not the value. It'll show you how much money you will get back that particular year.
I'm going to save you here.
Yeah.
Okay.
Yeah.
And this is, look, we've talked about cap rates a couple times. You're not in the industry, and the people that are in the industry are confused and misuse this term all the time.
Yeah.
Not unlike you just did. Okay.
Yeah.
So don't be too hard on yourself.
Okay.
But here's what a cap rate is. Here's what a cap rate is. It simply is the relationship. It's a percentage that defines the relationship between the net operating income and the value. That's it. So if there's net operating income of $10,000 and it's a cap rate of 10%, you can figure out what that property should be valued. So if the NOI, net operating income, is $10,000 and the cap rate is 10%, what would be the value?
10% of $10,000? Is that what you said? 10,000?
10,000 is the NOI, 10% is the cap rate.
Be 1,000. Wait, you multiply it, 100,000.
It would be 100,000.
Yeah.
You take the NOI and you divide it by the cap rate,
That's 1,000.
which 0.1.
0.1.
10% is 0.1. So you're dividing by a fraction, so it'd be larger.
Yeah.
So 10,000 NOI divided by 10% cap rate, the value of that property is $100,000.
Okay. Yeah.
Your value's almost always going to be worth more than what the net operating income of that property is.
Okay. Yeah.
Yeah. So all cap rate tells you is in the year that you buy it, I paid this much for this much NOI for that year.
Yeah.
That's all it tells you. It describes the relationship for that year between value and net operating income. It's not a return.
Right.
And that's how people use it most often.
Yeah.
Now, what is net operating income? Like, how do you arrive at that number?
What are the expenses?
Okay.
Right. And what are the rents?
Mm-hmm.
Right? Or the money that you're getting back. So it's the difference of the two of those.
Yeah.
Yeah.
Let me just be a little bit more specific. Okay.
Yeah.
So you take all the revenues of the property.
Mm-hmm.
Mostly that's going to be rents.
Yeah.
In an apartment complex, it might be laundry income. Self-storage facility like ours, we have a lot of late fees. That's part of the revenue. And an office building in Chicago, parking would be a revenue source for that property. So that, whatever happens to be in the revenue, mainly it's going to be rents plus some other revenue stuff.
Yeah.
Revenue minus the expenses of operating that building.
Mm-hmm.
So it's the expenses that are tied to the operation of that building, like property taxes, insurance, security,
plumbing.
Yeah, any kind of maintenance like that.
Yeah.
To the systems of the building, HVAC, plumbing, electrical. You got
landscape, parking lot.
Yeah, landscaping. All that stuff is tied to the operations of that building. So take all your revenues minus the operational expenses. That will get you to the net operating income. What about debt service?
What about it?
Do you factor that into net operating income?
No.
Why?
Because it's not part of the operation of the building.
That's exactly right. That is an expense tied to the owner of the building.
Mm-hmm.
Somebody buys it with cash. They don't have a mortgage payment.
Right.
Somebody buys it with 100% financing. They got a huge mortgage payment. The NOI of that building is going to remain the same.
Yeah.
Whether somebody buys it with cash or, so there are some expenses that are tied to the owner that will be below the net operating income.
Sure.
So the key to figuring out the cap rate is really being able to dial into what the net operating income is.
Mm-hmm.
Then you can look at the market, see, all right, properties like this are selling at this kind of cap rate, apply that cap rate to that net operating income, and then you can tell an owner, hey, your property should be valued at this.
Yeah.
And that's cap rate.
Yeah. Cool.
Nicely done.
Yeah. Sweet. That's it.
What are we doing?
We're talking about next week's episode.
There it is right there. Oh, I should look right there. So you're going to find out on the next episode exactly how I pitch.
It's a real pitch deck.
I'm going to take you through the pitch deck itself as if I'm pitching the deal to this guy.
Yep. And you're going to see me wearing a sports jacket.
Really?
Yeah, I played a role. Remember I throw on that suit jacket?
Oh, yeah.
Remember, like I got the money to pitch an investment?
All right.
Man. Oh, hit subscribe. And
yeah.
Write your questions. And click the links. And we're on social media.
Just do what we say.
Yeah. Bye.